Welcome back. Today, we're jumping right into a really fascinating economic paradox that just played out on Wall Street. If you're someone who loves figuring out the hidden gears turning our financial markets, you are in the exact right place. In this explainer, we're going to look at a situation where the usual rules kind of flipped upside down. We'll break down exactly how market resilience managed to show up right in the middle of shifting inflation and some pretty intense geopolitical tension. So, why did markets bounce during a war-driven oil spike? I mean, normally bad global news, especially when we're talking about conflict and crucial commodities like oil, that equals instant market panic, right? You'd totally expect a massive sell-off. And yet, here we saw both stocks and bonds actually bounce. On the surface, it's a complete contradiction. No way that makes sense. So, how do we unpack this? Okay, let's dive into this. Section 1, the market paradox. Let's set the scene for a second. The markets were suddenly staring down a massive headwind. Renewed clashes in the Persian Gulf had just triggered this war-driven spike in oil prices. And you know how this works. That kind of geopolitical tension creates immense negative pressure. Oil is literally the lifeblood of the global economy, so a spike in its cost acts like a massive weight on growth. This is exactly the kind of shock that typically sends investors absolutely running for the hills. Which brings us to Section 2. Oil spikes versus inflation, a real tug of war. Picture a giant seesaw. On one end, you've got this heavy downward weight of a war-driven oil spike dragging market sentiment down. But pushing back up on the other side is a powerful, totally unexpected force, a slower than estimated rise in inflation. This absolute tug of war between the negative shock of oil and the positive buoyancy of slowing inflation is exactly what defined this unique moment. Basically, that slower than estimated rise in inflation brought a much-needed degree of relief to investors, despite those spiking oil prices. All right, moving to Section 3, the Fed's surprise gauge. Now, what's really interesting here is the specific catalyst. The Federal Reserve has a preferred inflation gauge that they monitor super closely, and traders naturally watch this thing like a hawk. Right in the middle of the oil panic, this specific metric did the completely unexpected. Both the stock and bond markets rebounded after the Fed's preferred gauge surprised everyone by revealing inflation was actually rising slower than estimated. It was this crazy beacon of positive news cutting right through all that geopolitical gloom. To really get why this surprise was such a game changer, we have to look at what traders were already terrified of. Before this data dropped, the fear was that mounting price pressures would absolutely force the central bank to step in and raise interest rates. The logic was simple but scary. Higher prices equals forced central bank action. So by showing a slower than estimated rise instead, this gauge essentially neutralized those fears of an impending rate hike. Just a huge sigh of relief. So let's look at Section 4. Wall Street's muted reaction. And this brilliantly illustrates how it all shook out. The Fed's inflation surprise acted as a major catalyst, spurring a really nice bounce in stocks and bonds right off their session lows. But, and this is a big but, the overall action was still fairly muted on Wall Street because those renewed clashes in the Persian Gulf were still lifting oil prices. It was a solid bounce, for sure, but definitely not a runaway rally. The heavy reality of the oil crisis kept the broader celebration pretty contained. Which leads into Section 5, why this matters. So the crucial point we need to take away from this explainer is that slower inflation acts as a remarkably powerful counterweight to global geopolitical shocks. Even with severe situations like the clashes in the Middle East driving up oil, domestic relief on the inflation front provided just enough counterpressure to balance things out. It literally prevented a total market sell-off and pulled stocks and bonds up from their lows even if the broader action stayed muted. It's just a great reminder that markets are incredibly complex systems. They're almost never driven by just one single headline. Which brings us to a really compelling question to end on. Will this inflation relief outlast the ongoing pressures of the Persian Gulf? Ultimately, which macroeconomic force is going to win this intense tug of war in the long run? Is it going to be the buoyancy of slowing inflation or the heavy weight of those war-driven oil spikes? Honestly, that's the big question to keep in mind as we watch the financial landscape evolve. Thanks so much for hanging out with me for this explainer. Keep analyzing the data, keep questioning those headlines, and I'll catch you next time.